Denison Mines is flying under the radar and under $2. With uranium prices rebounding and nuclear energy staging a global comeback, the question on every savvy investor's mind is, could Denison Mines be one of the most promising rebound plays of 2025? While tech stocks dominate headlines, Denison's low price and high potential make it a compelling candidate for a strong comeback. In this video, we'll unpack whether this deeply discounted uranium stock is a smart buy or a trap best avoided. Before we dive in, make sure to hit that like button, subscribe to Stocks Telegraph, and tap the bell so you never miss data-driven stock insights, especially ones hiding in plain sight. As of June 3rd, 2025, DNN is trading at $1.52, giving it a market cap of roughly $1.36 billion. That's down 15.6% year-to-date, dragged by uranium price swings and a hesitant retail investor base. Over the past year, DNN has swung between a high of $2.47 and a low of $1.08, highlighting its volatility but also its upside potential. Uranium prices themselves have bounced back to nearly $70 per pound after falling to the mid-60s in the first quarter. The renewed strength is partly due to U.S. executive orders pushing nuclear power, and momentum could build further as the clean energy narrative intensifies. Denison Mines is no newcomer. It's a well-established uranium developer focused on Canada's Athabasca Basin, one of the richest uranium-producing regions in the world. Its flagship project, Wheeler River, includes the Phoenix and Griffon deposits. Denison holds a 95% stake in this high-potential asset. The Phoenix deposit is planned as an ISR operation, a low-cost, high-efficiency mining method that dissolves uranium underground and pumps it to the surface. It's forecasted to operate at just $6.28 per pound, potentially making it one of the cheapest uranium producers on the planet. Griffon, meanwhile, is set to be developed through conventional underground mining. Denison also holds strategic interests in other promising Athabasca properties, including a 22.5% stake in the McLean Lake joint venture, which houses a functioning uranium mill, a 25.17% interest in the Midwest deposits, and a 69.44% stake in the THT and Husky deposits. This diversified portfolio gives Denison significant leverage in the uranium space. Several major catalysts could drive Denison's future growth. First and foremost is Wheeler River's timeline. Public hearings with Canada's Nuclear Safety Commission are slated for late 2025, and if all goes well, construction could begin in early 2026 with production targeted for mid-2028. If successful, Phoenix will become Canada's first ISR uranium mine and the first new large-scale mine in northern Saskatchewan in over a decade. Uranium market fundamentals are also turning bullish. Spot prices are pushing $70, while term contracts approach $80. Some analysts expect prices to reach $90 to $100 as demand soars and supply tightens. Clean energy mandates, global electrification, and geopolitics are all putting nuclear energy back on the map. In the U.S., new executive orders support nuclear power expansion by accelerating licensing and incentivizing domestic production. Tech giants like Google, Amazon, and Meta are backing nuclear to meet their carbon goals, offering another tailwind for the industry. Despite all these positives, Denison remains under $2. Why? Investor caution centers on Wheeler River's development. Regulatory approvals are pending, and delays could throw off the timeline and increase costs. Financing is another concern. Building out Phoenix won't be cheap, and Denison will need additional capital to move from development to production. Market volatility is another factor. After uranium spiked to $82 in early 2023, prices corrected sharply, shaking investor confidence. While recovery is underway, volatility remains high. Broader macroeconomic uncertainty, from geopolitical risks to energy policy shifts, has also weighed on sentiment across the sector. Lastly, Denison's pre-production status may deter investors who prefer established uranium producers already generating revenue. That creates pressure, but also opportunity for early movers. Analysts are optimistic. As of June 2025, DNN carries a consensus buy rating with a 12-month average price target of $2.88, an 89% upside. The highest target is $6, reflecting confidence in Denison's potential once regulatory hurdles clear. Institutional ownership is another strong signal. Around 36.74% of Denison's shares are held by institutions, including Murray Asset Global, 6.49%, and ALPS Advisors, 6.45%. Van Eck Associates and Segra Capital are also key stakeholders. Hedge funds are increasing positions too. Bridgewater Associates raised its stake by over 40% last quarter. Even insiders are buying. CEO David Cates purchased 10,000 shares at $1.42 in September 2024, showing belief in the long-term outlook. That said, risks remain. The regulatory path is complex, and while Denison has filed its environmental impact statement, final CNSC approvals could take time. Any delays could push back construction and hurt investor confidence. Uranium prices are volatile and heavily influenced by global supply disruptions, tariffs, and geopolitical shifts. For example, early 2025 saw a 12% dip in spot prices, tied to concerns over Canadian tariffs and Russian supply instability. Reacting to price shocks in uranium isn't easy. Supply chains are long and inflexible. Competition also looms large. Cameco and NextGen Energy have bigger budgets, deeper reserves, and more production-ready operations. Denison's strategy is strong, but it's operating in a space filled with heavyweights. Several events could act as triggers for a DNN breakout. First, regulatory progress at Phoenix, especially if the October and December CNSC hearings go well, could send a strong signal to the market. If construction is greenlit by early 2026, investor interest will likely surge. Second, Denison's strategic partnerships are expanding. Its collaboration with Kosa Resources adds exploration firepower and operational synergy in the Athabasca Basin. Third, the broader market trend is favoring small-cap commodity stocks again, as investors rotate out of overvalued tech and into real assets tied to global energy themes. Companies like Denison are getting a second look. And finally, with uranium prices recovering and possibly heading higher, even modest tailwinds could significantly reprice stocks like DNN. Denison Mines is one of those classic high-risk, high-reward plays. With a current price of $1.52 and a bullish analyst target of $4.38, the stock has over 180% potential upside if things go right. Institutional backing is strong, insider confidence is growing, and fundamentals are shifting in its favor. Still, it's not without its challenges. Regulatory delays, market volatility, and stiff competition could limit near-term upside. But for speculative investors with patience and a belief in nuclear's future, DNN might be one of the most overlooked uranium opportunities on the market. If this breakdown helped clarify DNN's potential, smash that like button, subscribe for more overlooked opportunities, and let us know. Are you betting on Denison Mines or sitting this one out? Drop your thoughts in the comments. We'll catch you in the next deep dive from Stocks Telegraph.